I often don't believe that sustainability alone sells much of anything. I think the product has to be good or better or different or special or something. And the sustainability needs to be this awesome bonus add-on. The way that I believe most
Right.
people, if they're super environmentalists, that's not why you buy a Tesla. That's why you buy like a Prius. You buy a
Hmm.
Tesla because it's this cool,
Right.
awesome car, and it
Yeah.
happens to be environmental, and that increases virality of the consumers of the product to say like, I have a Tesla, because it's good for the earth, and it allows them to kind of brag about it.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Ryan Springer with us. Ryan is a founding partner at Midnight Venture Partners, a growth stage consumer DTC investor. In this episode, we talk about how Midnight Venture Partners got started, trends in consumer and DTC space, common mistakes that founders make, cost effective acquisition channels, importance of retention, difference between D2C and retail, why sustainability products need to be better than competition, and lots more. So, without wasting any time, let's dive straight in. Hey, Ryan, so good to have you on the VC10X podcast. How are you doing?
I'm doing well, Prashant. Thank you for having me. I'm excited.
Yeah, absolutely. Likewise. And so glad to have you here on the podcast and talk about all things D2C. So, to get things started, what's your story and how you started investing?
Uh, I usually make a bunch of nepotism jokes when it comes to my story. My dad started a retail strategy house in the 90s um, with an awful name, actually, called the Touch Agency. I still think it's a terrible name for anything, really. But
Yeah.
he's been building retail strategy, data analytics, and pro analytics, some retail execution since the 90s,
Yeah.
and I grew up working
Hmm.
for him. So I kind of grew up in the dinosaur world of brick and mortar, not D2C. I've had to learn a lot about D2C from some of my partners at Midnight over the past couple of years. But I got into investing because uh, in working for him, we helped he primarily, but we helped build some of the most successful brands in natural, better for you wellness, and we didn't know how to take equity. And I think that I was always driven by, we're seeing a lot of great deals, we're seeing a lot of great brands. How do we get in a meaningful way on the cap table of some of these more exciting ones, and help kind of shape them and help them not make the mistakes we saw them making over and over again, just like we were on our side of the table. And so getting into investing just felt like a natural extension for my partners, Chris Adam and Alex Bodney and I, when it came to seeing, okay, well, we've got this retail strategy house that sees a bunch of the deals in wellness. We've got some connections in the space. Why don't we see what we can do in terms of making a fund that can add an unusual amount of value. Everyone kind of says they can, but an unusual amount of value and see an unusual amount of deals. And so that was our kind of entrepreneurial light bulb to start Midnight.
Right. Sounds great. So, how long has Midnight been around and what's your investment thesis been like?
We've been around for around 2 years, I would say, a little over 2 years. Our investment thesis is mostly seed stage, consumer, primarily focused on wellness products, with a specialty in CPG, just given the heavy
Hmm.
CPG background that I come from. Um, and um, we write 500K to $1 million checks. We'll do SPVs significantly above that, but the actual seed fund writes seed checks. We'll also do SPVs at a later stage, like much later stage deals, like the other side of the barbell, like beginning and end, like right before you exit, and right in the beginning is kind
Right.
of where we play at Midnight. Um, and I'm sure you have a million more questions about that can shape out kind of our thesis. So I won't go too long on, the retention rates we like to see and the burn rates we like to see,
Yeah.
and revenue and things like that. So I'll stick with just kind of early stage wellness.
Yeah, sounds great. And now let's get into the D2C space. So, what are the exciting trends that you're seeing, and how do you look at this entire space in general?
D2C for consumer, you mean?
Yeah, absolutely.
Um, Exciting trends. Well, it's not quite an exciting trend, but a trend I've noticed that everyone's aware of is ever since iOS 14, it's been a lot tougher to sell things online. And so one of the more, for me as a dinosaur retail guy, one of the more exciting trends is that retail, which everyone felt like was going away, is coming back in terms of importance. in a really big way. It's difficult. It's more difficult than it's been in a long time to launch or scale a D2C brand. Your CAC, customer acquisition cost, is higher. If you're an item that's under $40, it's especially tough. Let's say you have a 50% gross margin on a $20 item, just gross, you're making $10. Your CAC's probably 40 or 50. You got to sell 4 or 5 of these things to even break even. And that's not easy. And so when it comes to, exciting trends for me is omni-channel is more important than it's ever been. You need to be good at D2C and you need to be good at retail. And that's difficult. Very few people have both of those backgrounds. It's a little bit where we come in at Midnight. We have D2C partners and retail partners that are excellent. But the trend I'm seeing that, it's been popular for a while, this isn't new, is, 0 to 10-ish million online and then bridge over to retail. I'm seeing founders focus recently more on burn rate, more on retention than I think they had before, and I think that's a really healthy thing for businesses going forward. In terms of trends online, that's tough for me to say. There's a lot of adaptogenic, like reishi, chaga, mushrooms, more nootropic, more focus on mental health, and I think that's great. Um,
Yep.
Keto seems to be going away a little bit.
Hmm.
We're seeing far less searches for keto on Google. A lot of brands that have positioned themselves as keto now need to position themselves more broadly,
Yep.
because the principles of keto is still good, but that's another trend that I've seen.
Yeah, absolutely. And like when you're looking at all these deals that are coming in front of you in DDC and consumer, so how are you making the evaluation that are these good deals to invest or not? What are the kind of key things that you're looking for?
Retention. A
That's
lot of
hmm
brands focus on acquisition. That's important, of course, but
right.
uh, are people buying again? That tells you whether or not you have a business or just a creative way to burn a lot of cash. Just because
Hmm.
you have product market fit. So we like to see a certain percentage of consumers buying more than once a year. If you're selling a couch, this is different. It'd be pretty weird if you're selling two
Yep.
couches to the same person
Yeah.
every year, but that's usually not the kind of brand I'm talking about. Whether it's a beverage or um, uh, grain-free pretzels like FitJoy, one of our portfolio companies. High retention rates are critical. If you don't have them, then you haven't figured out your product market fit, and if you haven't, then you shouldn't scale, because everything's going to cost more and go worse. Just because you're acquiring a bunch of consumers who aren't coming back, you're really just turning
Right.
off a bunch of people to your brand, because whatever it is doesn't work for them. Um,
Yep.
and so, number one would be retention, probably. Although there's a lot of must-haves. Another one is a scalable gross margin. Um,
Yep.
Whether it's good now or we clearly can see it can get good, it needs to get to a point where
Hmm.
acquirer would find it attractive.
Right.
Um, Burn rates that match up to the category and life stage of the business. You can burn capital, but only if the metrics make sense and the burn is strategic and we feel like you're going somewhere. Um,
Right.
Prefer brands on the lower end of the burn scale, and then finally, acquisition is important. So, an ability to game the system to get as low a blended CAC as you can get blended with organic, um, is critical. An ability to leverage influencers, or to have a brand that influencers like, kind of peddling, whether that's affiliate or classic influencer, is also super important.
Yeah, absolutely. And like talking about all these different acquisition channels, which one do you think is performing the best for DTC brands these days? Is it influencers or is it paid ads or is it something else?
It's influencers by a mile. Um, if you can do it well, it's hard. It's really hard. You always
Right.
see these brands like all you gotta do is make viral videos. Well, if that would make you
Yeah.
famous if you're really good at that. You shouldn't even do a brand. You should just be an influencer yourself if you're that capable of making viral videos. So
Yeah.
this is obviously easier said than done. One of our portfolio companies that's doing really, really well is called Jolie. It's a filtered shower head. Their whole messaging is like step zero, your beauty routine should be removing the chlorine and other chemicals that you're pouring on your face and hair, damaging your face and hair. Every day you feel better, your skin feels better, your hair. Let's say a lot of women color their hair. Your color will last a lot longer, look a lot better if you're filtering your shower. And so, Jolie has an unbelievable Instagram. If you follow it, I think you can learn a ton about leveraging influencers to grow a business. They've done unbelievably well. I won't share the metrics on the podcast, but it's crazy how they've scaled
Yeah.
and how profitable they are. And they've done almost all of that by incentivizing user generated content or kind of organically just by
Hmm.
building this culture. And so influencers seems to be the most powerful. Google and Instagram, Facebook ads are still, if you know what you're doing, you're sophisticated, and your product and price point lends itself to that your category, those can still be good. The rumors of their demise, I think, is overblown. So I think you can still do paid. It just has to make sense, and it makes sense for less people than it ever has before. Um, and so and then finally you see I think this one's another tough one to pull off, but affiliate. So affiliate codes, people driving traffic back to you. It worked really well for one of my partners when he was with Daily Harvest, and you can see it work with the right brands. So
Yep.
I don't think I see people struggling. TikTok is a two-headed beast. I see a lot of people struggling to get any value out of the paid piece of TikTok. And I see brands doing
Yep.
unbelievably well with the generated content side of TikTok. So
Yeah.
the people focusing on building organic on TikTok, if you're capable of doing it, you can do extremely well.
Yeah, absolutely. And does that also like make sense from the cost perspective as well? Because in the ads, you have a set price for a set number of views that you're going to get, and also there is a tag that okay, this is an ad, and you perceive that
Hmm.
differently, right? But in case it's an
Correct.
influencer that you already follow is sharing about that, then you're more likely to listen. And also, how does the cost work? Is it like a one pricing model that okay, we charge this price for one reel that we're going to make or one TikTok that we're going to make, or is it based on how many views it gets? Let's say it goes viral, then it's going to cost a lot more. Is that kind of pricing also working?
It totally depends on the influencer.
Okay.
The
Yeah.
best case that you can get,
Hmm.
what Jolie does is often doesn't pay for influencers. They're often sending the product, incentivizing them with free stuff, but very seldom cash. Um,
Yeah.
they want authentic fits where the influencer really is like, I want this really badly. I actually want to tell people about this. This is phenomenal, and that comes down to that retention and product quality over again. If your product's good enough, influencers are going to be far more open to influencing. Um, and also, it's wonderful if the big account influencers post something, but the micro influencers, the people in the middle, are just as important and often much easier to work with and get to. So,
Right. Agreed.
a lot of the most successful brands that I've seen, at least in hardware, it's kind of giving it away
Yeah.
is a really powerful tool.
Yeah.
It's
And
not
that's
the
a
same when you got to pack
yeah.
energy bars than when you
Yeah.
have like a filtered shower head that costs, $140. But
Hmm.
um, just giving it away, asking them to do the unboxing process, that's worked really well for some of our portfolio companies. Now, paying for it, sometimes that can work, sometimes it can't. I
Right.
really encourage
Right.
brands to follow the metrics, and that's a lot squishier. That's where affiliate helps, where you can see how many people are using the code, so you can track
Yeah.
much closer how things are going. Now, D2C, if a big influencer posts and some of your sales skyrocket, well, it doesn't take a rocket scientist to tell that was connected, but
Yeah.
it's still harder to
Hmm.
judge metrics from that angle.
Yeah, absolutely. I totally agree. And yeah, that's a great approach, even for DTC companies who are starting out and do not want to spend a lot. Then I think giving it away is one great way to like get your brand out there. Uh, in hands of the right influencers, and then if they choose to share a video about it, then you're good, right? And let's now talk about one of the recent investments that you've made at Midnight Venture Partners, and why you made that investment, if you'd like to share.
Sure. I'll talk about, there's a lot of good ones. I'll talk about VAE, VAE. It's a caffeine spray. It essentially, there's other caffeine sprays in the market, but they contain a really low amount of caffeine per spray. So you would have to spray them like 20 times for a cup of coffee, which is just an awful lot of sprays. They is 20 to 25 milligrams of caffeine per spray. So it's more like 3 sprays for a cup of coffee. It's very small, it's very mobile. We have fantastic margins. I can't say who else has invested in the deal, but some very, very strategic groups that have helped us access distributors and relationships we wouldn't have otherwise had, that are allowing us to scale quite quickly. They just launched on DTC, I think yesterday, the day before. And essentially what it is a 0 calorie, 0 sugar, caffeine plus L-theanine in a suspended liquid. Part of what makes VAE special is their ability to have solubility of caffeine at the levels required to make it only, take 3 sprays to get energy. But we like it because, it hits almost every value prop of a consumer. It's cheaper per milligram of caffeine than almost anything else on the market. It's exponentially more convenient because it's always around and it's this tiny little stick. It works really quickly, and then finally, it's healthy. Most people's energy is either coffee, which is far less healthy than this, or energy drinks, which is unbelievably less healthy than just caffeine and L-theanine to control the crash and to keep you kind of even. And so I think it can, and you're not taking like 200 milligrams at once. You can. It's very variable. It's whatever you want to do. But I think it's healthier to kind of take like 60 and then 20, 20, 20 in the next couple of hours, like little bumps. That allows you to, I think, have a healthier relationship with caffeine. And so that one,
Yeah.
that one we're pumped about. There's no other spray on the market that can deliver that much caffeine per spray, and therefore actually be usable.
Yeah, absolutely. Sounds very exciting product, and would probably put the link in the show notes for people who might want to go and try it.
That'd be
So
great.
now, yeah, and now let's talk about, how do you support these investments once you've made these investments? Then how do you support them in, like, be more successful in what they're doing?
So first, you have to take a step back to understand who we are at Midnight. So the nepotism jokes I had. My dad and his business partner Aaron are partners at Midnight. They've helped build multiple billion-dollar and $100 million CPG brands at retail. Our D2C partners are Red Krypton, uh, and they have helped build multiple billion-dollar and D2C and $100 million D2C brands from the ground up. Often, our specialty is like 0 to 1, 0 to 2, 0 to about 60 to 100 million across both those groups. And our general partner on the operations side is a guy named Ken Meyer, and he ran the eastern half of Whole Foods Market for 15 years and ran their supply chain. And so, unlike a normal fund, you have elite retail, elite D2C, and elite ops general partners. So we split the pie more ways than a normal fund, with the idea being that we could bring far more horsepower on the value add side, again, than the average CPG fund. And that's the goal we've had since the beginning. Doesn't mean, we reach it every day, but we're excited about the team we built, and it's going well for the first 2 years. So having taken that step back, we work with the brand in a versatile ways. It's whatever works for the brand. If it's checking in on a quarterly basis because they're killing it and they don't need a lot of help from us, that's fine. If it's running their retail and D2C, which we do for 2 of our brands in our portfolio completely, that's fine. So it's a whole spectrum. I recently introduced one of our portfolio companies, 2 of our portfolio companies actually, to Costco, which I think can help a lot. We got one a multi-million-dollar line of credit. We've helped build their retail strategies, connected them with the best Amazon groups, connected them with brokers, connected them to each other to hey, you're doing this well over here, help our other portfolio company and vice versa. So there, and then finally, and honestly, the easiest one is help them raise money. Raising money for ourselves is tough. Raising a fund is really hard. But when you have a good portfolio company and the network we built with other funds, it makes it fun and easy to kind of be like, okay, here's the top 10 or 20 CPG funds that are the next level beyond us in terms of check size and where they play. Go meet all of them 9 months before your next round and develop those relationships. And then you'd be amazed how differently the round goes when all the top growth funds know exactly who you are. They've been watching you. They know we like it. They know it's doing well. So just getting ahead of things, helping brands make strategic decisions, when to go to retail, why, where, how, all those things. We can do those things really easily. And the balance for us is making sure we're always collaborative with the founders, because we came in thinking, hey, these VCs are always, a little out of line, a little arrogant, a little whatever. And then you make your own investments and you see the investments making mistakes that I've made before. And so you're trying to say, like, don't do what I've done. But sometimes you got to touch the stove to know it's hot. And so we're trying to find that balance between being really involved, but also not being too hands off. And we're early, so I think we're still figuring that out.
Yep. Absolutely. And talking about mistakes, you just mentioned that we don't want the same mistakes to be made that we've already made by our founders, right? So, what are the most common mistakes that founders make in the D2C and consumer space?
Over hiring. They get a big venture round and then suddenly think they need Silicon Valley level headcounts and stuff, and they don't. So over hiring, which bleeds into burn rate. The number one mistake is the burn rates of some of these businesses is just, it's silly. You kind of look at the business and go, there's no reason why this should be this high. And when you tell founders about it, the great ones tend to go, okay, well, where should I be? And where am I burning too much? But a lot of them, understandably, and I think I would be one of them too. I've got a separate business other than the fund. Uh, and so I've made, it's funny, I give advice on the fund, and then in my own business, I'll make a mistake that would have, my own advice would have helped with, but it's complicated. You're way closer to it as a founder. It's hard. Um, and so I guess what I'm trying to say is, uh, often when you tell a brand their burn rate's too high, they're like, oh, there's no way to make it lower. It turns out there's like a bunch of ways to make it lower, and they just didn't, it's hard to understand that when you're that close to the forest. So I would say overhiring, burn rate. And then finally at retail, we don't allow it's the only place we really plant a flag. But I see a lot of founders that I'm talking to on a daily basis pitching me. They're going to the wrong retailers way too early or way too late, or any number of things where their retail strategy is all jacked up. And they're very naive often about how it's going to move. And I don't think they understand how difficult big retail is or how much it's going to cost. And everyone seems to think you're going to have this like sales velocity, units per store per week, that's like way higher than it's actually going to be. Um, and so being naive about retail is another one that I see fairly often. And there's no way to know that unless you're aggressively going out and asking people who know what they're talking about, or do my numbers make sense? Just socializing them with retail experts. And not everybody knows a bunch of those. So they're all understandable mistakes, but those are three among many that I see a lot.
Yeah, absolutely. And let's talk about the difference between D2C and retail, and like how do these two are different in they operate, and do founders confuse that how these two operate?
Um, there's a million differences. One would be D2C allows you a tremendous amount of first party consumer data, and retail allows you such a cloudier picture of who's buying the product. You can get pretty detailed information if you have an extraordinary amount of money that it makes no sense to spend until you are very large. If you're buying like, retention level consumer card data from Kroger or Albertsons Safeway, you can get a much better idea of who this person is that's buying, how often they're buying. That's unbelievably expensive and so far outside of what a startup brand should be purchasing. So I think the cloudiness, the disconnectedness, you're also going to a distributor. 3PL, not the same thing, but you do have a middle person on a D2C brand as well. But the distributor relationship is, I find that to surprise a lot of founders, how almost adversarial it is if it's a big broadliner. If it's a DSD, that can be different. If you're a beverage and you're texting them every day, you're going to war with each other, and it's awesome. DSDs can be super hard too, and that relationship is even more complicated. But the big UNFIs and KHEs of the world in wellness, they're not your friend at all. And I think
Yep.
people get blown away by that. And then finally, you can just put something for sale on your website. You got to go somehow convince the Whole Foods buyer who has 5,000 other versions of whatever you are that you need to get on shelf, and they're going to give you one shot a year at some time that they've decided. So I want to get in Whole Foods. Well, the category review date's in September, the third week of September. There's nothing I can do to get into National Whole Foods until then. And you're sitting there going like, well, should I go into other retailers that aren't as good of a fit? What do I do? How do I? That's so far from now. And then you get to the third week of September, you have a meeting, it goes okay. You have no idea if you're in or not for months. And so it's just an ultra different. Now, the nice part about retail versus D2C is scalability of retail is amazing. And scalability of D2C gets harder and harder and harder, honestly. Your CAC will go up. The people you're targeting get more and more wide and less of a perfect fit for your product. The thing that frustrates me about D2C is if I'm doing really well, and I've got a good product, somebody could come into my category online with a bunch of money and a terrible product. No one's buying it. But even if they just buy ads with all my keywords, my CAC has gone up dramatically. If I own distribution at Walmart and Target, and some little guy wants to come in, but they have a bunch of cash, it's tough for them to buy their way into Walmart or Target. Even if they do, they're not increasing my CAC is the same. I'm still sitting on the shelf. I'm still running TPRs. I still own the real estate. It's a lot. In my opinion, this is just an opinion. You'll see a lot of strategics or investment banks telling you that D2C only brands actually take a little bit of a cut in valuation because it's much easier for a challenger to come in and mess up their business. Where retail, much harder for someone to come in and just turn your business upside down by
Yeah.
spending a bunch of money. It's still there. Competition's still a big thing, but
Hmm.
you own real estate, so it's different. Those are just some of like 100 differences that are nuanced between D2C and retail, and it's increasingly important the founders understand those differences and navigate them in an intelligent way.
Right. And do you think that maybe founders should think about it in a way that, okay, they're starting off at D2C brands, but then later on they mature into retail brands because that's the bigger area to play in, and it's easier to scale in retail than it is to scale in D2C. So that's how founders should be thinking that, okay, we start off as D2C brands selling online, but then eventually we get into retail and scale there.
I want to caveat my easier to scale in retail than D2C. It's if you have momentum.
Hmm.
If you're a
Yeah.
great brand with momentum, retail is going to end up being how you get to 200 million,
Right.
much easier than how you would get there with direct to consumer. If you don't have momentum, they're both really tough, and retail might even be harder because the buyers just won't buy you.
Right. Right.
Um, so I do want to clarify that because there's probably going to be some brands watching this
Yeah.
that are
Yeah.
struggling.
So
Like, I don't
so
know what this guy's talking about, but retail, I can't even get on the shelf. So
uh-huh.
your question was, D2C first, then retail. That's a little bit of a classic playbook by now. It's still very much a smart way of doing things. One trick that we like to employ at the fund is brands will be on D2C. They'll grow like 10 to 15 million, and then they're going to start and try and go straight into like a Target. And I'm actually not a believer in like building slowly through the natural channel of Whole Foods and Sprouts. That takes forever. It's just as hard. The revenue's not quite there. I'm not a believer in that path. But what I am a believer in is establishing a laboratory in between that transition. So if you're D2C at 10 million, go find a central market in Texas of 10 stores that turns a bunch. Erewhon's a bad example. Another smaller chain that you can just focus on for a year, learn what works and what doesn't. Learn to play poker with not that many chips, so you can lose and still be like, okay, and then go kind of take over the world, because they're two different businesses, D2C and retail. And just like D2C, if you can treat retail like a laboratory first and figure out what works and build a playbook, you're going to burn a whole lot less cash learning a bunch of expensive lessons at some giant national retailer. Because if you go in blind and you go to Kroger nationally, you don't know what TPRs work, you don't know what messaging on the shelf works, and it's going to cost you a lot of money and a lot of pain to figure it out. If you do it at a 15 store chain as an experiment first, quietly, you're going to learn what TPRs work. You're going to learn what messaging works. You can scale that playbook, and it costs you a whole lot less money and pain to figure that out. There's actually negatives even to that plan in terms of Nielsen data and other things, but
Right.
to me, that's one of the smartest ways of doing it.
Yeah, agreed. And like you said initially in our conversation that you're seeing a lot of mental health focused products, psychedelics and stuff.
Yeah.
And are you also seeing some kind of attention to climate based products? Because these days that sector is also pretty much hot. Climate friendly products are coming up. So any DTC brands that you've seen in the climate space and how that space is actually shaping up?
Um, my own company outside of Midnight is a cactus vodka called High Desert, and we use exponentially less water than most. The big vodkas in America are mostly use corn, like a Tito's, and that's actually not that water intensive either. But the gap is still unbelievably big. It takes like 600,000 gallons of water to grow an acre of corn, according to Google. I'm not a farmer, but it takes zero to grow an acre of cactus, and that's a huge gap. And so my brand is very sustainable, but I often don't believe that sustainability alone sells much of anything. I think the product has to be good or better or different or special or something, and the sustainability needs to be this awesome bonus add-on. The way that I believe most
Right.
people, if they're super environmentalists, that's not why you buy a Tesla. That's why you buy like a Prius. You buy a
Hmm.
Tesla because it's this cool,
Right.
awesome car, and it
Yeah.
happens to be environmental, and that increases virality of the consumers of the product to say like, I have a Tesla, because it's good for the earth, and it allows them to kind of brag about it. And so I focus on brands that do a really good job of being whatever they are and are sustainable, not just upcycled for upcycled's sake. Um, there's a really great, surprisingly good veggie chip company called Pulp Pantry out of Los Angeles. It tastes amazing. It's much healthier for a consumer. It's actually got real nutrients and fiber that chips never have. It's made from the pulp left over from juicing vegetables and fruits. And so they've upcycled everything. So it's ultra sustainable. And they lead often with that sustainability. But I've been talking with the founder, Caitlin, super sharp, kind of about leaning more with the health benefits. It's a legitimately different health proposition to eat this snack. It's really good. There's another one in that category of chips called Kazoo, where they use upcycled corn germ, and that allows them to use far less water. And it tastes really good. It doesn't taste any different than a normal tortilla chip. So that's two examples in snacks. There's Ugly, which is a upcycled fruit company where they like use dried fruit. And so I'm seeing a lot of these in the snack category, and they're surprised, end up being really good. So upcycled, I think, is increasingly becoming a big thing on the sustainability side because consumers understand it. With Ugly, that's another concept consumers understand. A lot of the produce just doesn't look good enough to be on a grocery store shelf, but it's still just as healthy. It's still an apple, it's still a banana, it's still whatever. Using those products in a processed way, which obviously is a bad word, but in a way where you dry them out or slice them up or whatever, where it no longer is ugly, is another thing that we're seeing. But yeah, I think the main thing I would tell brands in the sustainability space is make sure you're excellent at whatever you are. It's not going to work.
Right.
You can't just hang your hat on sustainability. People aren't going to eat much shittier chips just because it saves the earth. They just don't do that. It's not how they behave. It's got to be as good or better.
Yeah, I totally agree to that, and that's also something that we have seen with eating a healthy diet as well, because we see that it's promoted. Everyone knows that what's healthy and what's not healthy, but still there is a lot of unhealthy stuff that still gets eaten, and but that's probably because that tastes good, right? Probably.
Mm-hmm.
And if you build something that tastes good and is healthy, then why not, right?
Totally.
And yeah, and love that example of Tesla as well, that you buy a Tesla because it's kind of a status symbol. It's fancy, right? It's a fancy car.
Yep.
It's cool, and it's not just because of climate. Of course, it's one of the biggest companies in the climate space right now, but it is able to do that because of that coolness aspect, and not only because it's climate, right? Because people will start caring about maybe climate at a later stage when the effects of it are very evident, although it should not be that way, right? Because we'll
Yeah.
be
Yeah.
struggling
Yeah. Yeah.
we'll be struggling by then. And VCs understand that, okay, this is a space that needs to be invested in, and they're backing all kinds of products. But I think that's an
Mm-hmm.
important factor that they need to be looking at, that, okay, is this unique? How is this different from the existing products? And how will this capture market share against what already is? Because sustainability alone will not make people switch, right?
100%. So we come in a
Hmm.
little pessimistic whenever we go
Right.
to sustainability. We gotta feel like the product is excellent. If we do, then we're really excited.
Hmm.
That's that rare part of the Venn diagram that you get in the middle, the
Yeah.
overlap, where you're like excellent plus good for the planet.
Hmm.
Then you're just hoping the margins and the burn rate and all that makes sense, and then
Right.
that's kind of where we would write a check.
Great. All right. So now let's move on to a rapid fire round, wherein I'll ask you 5 quick questions about the fund, and you have to give 5 quick answers. Sounds good.
Got it. Yeah.
All right. So the first one is, what are the sectors and regions you invest in?
Consumer overall, CPG, kind of a specialty, wellness within CPG.
What's the typical stage of investment?
Seed,
What's the typical check size you put in?
500K or 750K.
Where can founders pitch you in case there's a direct way?
LinkedIn. Definitely find me on
Okay.
LinkedIn. That's the easiest way.
Hmm. And where can listeners follow you? LinkedIn?
LinkedIn. I don't have any social media, unfortunately. So not like
Great.
they need to follow me on that anyway. So LinkedIn would be great.
Uh-huh. For sure. I'll make sure to put all those links in the show notes below. Thank you so much for coming on the show, Ryan, and sharing your insights on D2C and retail and how things work. And happy investing.
Awesome. Thanks, Prashant. I appreciate you having me.
Pleasure hosting. Bye bye.